Yeah.
All right.
I've got my trusty iPad here, KP, and
Nice.
believe it or not, on the screen I have a presentation you did pulled up.
Okay.
It's called Entering Brackish Waters. It's a subject you've talked about on this podcast, as far as I know.
Yep. I think
True
we
or
have
false?
talked about it. Yeah. True.
So, I thought this would be a good topic for today. We can let the audience know that this will be the core focus of the episode is just digging deeper into this concept of brackish waters. And the subtitle here is AE is shifting from financial engineering to technological reordering.
Mhm.
This is a presentation you gave at an event last week. You can kind of cover
Mhm.
the basics of what the event was and why you decided to present this here. But I know you've like at a high level presented what this idea is. Um, but I thought it would be really great if we actually dug into the presentation
Yeah.
uh, and walk through the granular details and the aspects of what this looks like in practice to actually either, if you're a VC firm, if you're a startup, if you're an A&E company, how to actually take action steps and
Mhm.
potentially ride this wave. I think that was the intent of the speech. Am I
Yep.
right?
Yeah.
So yeah, I mean, talk me through at a high level why you wanted to create this presentation for this event, and maybe even talk about
Yeah.
what the event was.
Yeah. So the event was the Zweig M&A conference. So it's mostly CEOs of, and I would say chief growth officers, chief strategy officers, and private equity people in the room, which was made this discussion even more interesting because you actually had capital allocators in the room. It just wasn't industry. So the Zweig event, it's basically focused on mergers and acquisitions in the AEC space. I would say mostly AE. Let's call it AE space. Um, so if you look at what's happened, when I was a lowly civil engineer back in the day, I I never saw a path forward in like staying in the industry because everybody just kind of built these firms and then there were partnerships or they were ESOPs and that's how they evolved. And what you've seen over the last decade really is this industry is really attracting having attracted a lot of private equity, right? So it used to be if you were Joe Smith and Associates and you wanted to retire, you sold the firm to your employees and that kind of thing. And so private equity showed up and they said, no, no, we'll buy your firm, right? So this attraction that private equity has had to boring businesses. And so what that's also done is it's created this interesting dynamic of if you want to exit your firm, you have a couple choices, right? You have sell to private equity, sell to your employees either directly or through ESOP, which if your employees have been in civil engineering, they probably are not that rich. So they're not going to pay you a whole lot because they can't. You probably just get some kind of earn out or something, right? Or some owner finance debt. And then these private equity guys showed up, right? And if you think about that, they've come in and said, no, 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 we'll buy you as a platform company, and then we'll go do a bunch of bolt-ons or tuck-ins. So buy a 250 person firm, bolt-on tuck-in, and then of course the last one was if you got large enough, some of the larger publicly traded companies like an AECom, like a WSP, or Jacobs will roll you up. And so the roll up strategy has been there, right? So this industry in the last 10 years, I would say, has been heavily exposed to, I would say, kind of corporate development through capital allocation or M&A, right? So that's been the construct. So what I presented, I think, is important because if we look at what's happening in the advent of AI and the advent of kind of AI roll-ups, um, I think it's very relevant to this industry because after all, AI is kind of quote unquote coming for the white collar job, so to speak, right? So It doesn't get any more white collar than engineers, so to speak, or architects. And so you've already seen it. You've seen it with accounting. You're seeing it with legal. You're seeing it in these other highly white collar jobs. The other, I would say, vector in all this is these are industries that are not super excited to adopt technology and transform themselves. So I think part of the talk was the PE playbook being one of financial engineering, come in, operationalize some things, start building KPIs, take it from kind of a mom and pop founder led business to more of a professionalized business. Maybe add some debt on the books to get some leverage to make some acquisitions. All the things that a single owner maybe cannot do from a financial engineering perspective, and maybe doesn't have the access to capital and or doesn't have the expertise. Right? They've just never done it before. They've been engineers, they've been architects, not private equity people. So gave my little talk, and we can unpack the talk, so to speak. But it really freaked people out. I was very surprised at how it freaked people out.
When you texted me that, I was surprised to hear that too. And let's just talk about that. Like what about, the topic is, I don't think it's like, it shouldn't convey threat. Like it shouldn't feel that.
It should be opportunity, right?
Yeah. That, as a co-creator of this thing with you, like I've approached it optimistically.
Right.
Like I was like, oh, this is what's happening behind the scenes. And like, it's interesting, it's compelling, and it's happening. It will happen to this industry. And you have a chance to like, to actually ride that wave rather than, essentially miss the boat. And, I'm also assuming that a lot of firms in the room, they actually weren't like, they weren't consolidated, right?
No,
Like anyone
no.
who's an owner, who's not a PE firm in the room and wasn't a part of a previous roll up, like everyone's looking for liquidity at some point, right? So to me, it's a very actually opportunistic topic. So yeah, I couldn't really understand why that happened.
So I wrote a separate LinkedIn post, and it was really about how corporate CEOs, I think it was my Sunday Scaries, which funny enough, the Sunday Scaries the topic was fear, right? And it came from this presentation, which I thought was fascinating, that the corporate CEOs were afraid. And so what were they afraid of? I was just kind of saying, like, they were afraid of new capital entrants coming into the market, new capital entrants that historically, I'm not saying is always the case, historically tend to pay a premium. They don't mind paying a premium. In this case, most of the VCs entering these space are operating out of evergreen funds. They're not looking at a 5-year, 10-year flip, which is what the private equity people. So what I would have heard, me as an entrepreneur, what I would have heard is, wow, more capital coming into the market,
Exactly.
I can sell for more. Maybe I can sell partially and still own some of the upside, partnering with venture capital. The people that should have been afraid should have been the private equity people, saying, hey, these wild VCs are going to come in and overpay and block us out of deals.
Mm-hmm.
What should have been the takeaway? Right? That should have been the takeaway. The PE should have been afraid, and the CEOs should have been, this is amazing. Oh my God, when can we talk? Right? But I think it comes to how kind of the founder mindset is so different than the corporate mindset. I think the founder mindset, we are highly indexed to optimism. Oh, there's more capital? Man, we can go build more. Oh, there's a change and shift in the market dynamics. Oh, we can go monetize it, right? I think for whatever reason, the corporate CEOs, they kind of index towards risk and fear. Oh, like, I've never talked to a VC. How would this even work? And they just freak out.
The status quo is changing. The surface area, the game that I know that I've been playing for a long time is changing.
Mm-hmm.
So it's, to me, maybe it's, It's the desperate feeling you get when that game evolves and you don't know how to play it.
Yeah, I think that's what it is, right? So I think that's where it stemmed from. I think what they should have been afraid of, right? I kind of look at what should they have been afraid of is I think with these models, right? The 250 person firm that is at scale, generating EBITDA, has a certain profile that's very attractive to PE. Those people should be a little bit afraid because now with the new VC entrance into the game, there might be more interest in investing or buying a 50-person firm, a smaller person firm, making investments that are high risk in R&D and kind of
Mhm.
leveling the playing field and
Mhm.
and basically creating a new breed of competitors.
Mhm. Mhm.
Right? You and I might look at a 50-person firm and say, "Hey, we can make that a 250-person firm or the equivalent of 250-person firm revenue in 2 years," which is unheard of because we're not interested in squeezing every penny out of it. So in many ways, these PE-backed companies are so growth constrained. You would think they would be growth oriented. They're actually very growth constrained because there's no risk capital if the payback is not under 5 years, which is the 5-year flip of all PEs mostly, right? They'll never invest. In fact, I would say most companies in the AE space that have gotten private equity funding, the R&D and innovation goes down because any meaningful innovation or R&D needs a longer time horizon than 5 years, and the PEs are unwilling to allocate that capital with no benefit to them.
Yeah, it's
Whereas
not
guys like
it's just increased costs, and it's not obvious where the revenue generation is going to happen.
right.
Yeah.
Whereas you and I probably looking and say, "No, let's throw a couple of $1,000,000 into R&D and create an AI tool that helps you design structural engineering building." Like we would take that risk. We would do that risk, right? We would make that bet.
Mhm.
That's what they should have been afraid of.
Mhm.
And the 50-person firms should be coming up to me saying like, "Hey, KP, let's go play. Let's go do this."
Yeah.
Right. So it's kind of bizarre, right? And then, of course, I step back and I two of my teammates there with me in the audience. I'm like, was I a poor like, did I communicate this incorrect? Like, when you communicate something with expecting a certain conclusion and takeaway from your audience, and the takeaway is very different, you say, "Well, I mean, I do this." I say, "Well, was it me or is it them?" So I was trying to understand what my part in this was that I communicated incorrectly, and my team was just like, "No, man, like I think they wanted to be afraid. They
Mhm.
wanted it like it was them."
Mhm. Did you sense any skepticism from the audience? Just like general skepticism of this idea is going to play out?
No, I think that was and you've heard me speak before. Like I'm not very I don't gain with style points, right? Like my deliveries. I think I have a very matter of fact delivery. And I said that to someone and they said, "That's what's so scary. You're so fact and data driven. You're not, you're not hyping it up or anything. It scares us even more. Like at least we can't even write you off to like you just hyping up AI or whatever. You're just giving us facts and figures and that's maybe the facts and figures are scary than me, being a hype guy for AI. But I think I think the reason there was so much fear is there wasn't a lot of skepticism.
Hmm. So let's get into the nuts and bolts of the model again. I think you've talked at a high level that AI is creating opportunities for VC to buy services companies and basically implement AI software to improve margins and change the cost structure. But there's a little bit more at play here, and so I think like just to dig into what you presented and essentially what the the audience viewed as a threat. So you have essentially there's the VC era playbook. So there's two acts.
Mhm.
Act one is to incubate AI native software. So that would be the idea of me and you or any any technology founders going out to build the software stack um, before you go acquire the company. The software stack that's going to change and offer operational efficiency,
Mhm.
improve the margins of the business. And I don't think it's too big of a leap for anyone to listen to this to know that
Mhm.
software can be built. Essentially, you're embedding AI into uh, into existing software to improve operations.
Mhm.
The second act, and this is the one that I think most people haven't heard about yet, but is becoming more and more common in the VC world, is to acquire the distribution. So instead of
Mhm.
selling that software that you go build, which is the traditional way that entrepreneurs would go to market, um, essentially what you're saying is selling is really hard. Adoption in our industry is really low. The implementation's bad. So
Mhm.
even when you sell software, like maybe they're utilizing 30 to 50% of the features and maybe not obviously changing the cost structure of their business. So you're saying, okay, I know the software that I've built with AI native tools is amazing,
Mhm.
and the only way to ensure that the utilization and the implementation is as great as it should be is to actually go acquire the companies and use it yourself. And
Mhm.
at the same time, while you're making that judgment call, you're also saying, "Hey, I'm gonna go compete with the market
Mhm.
and run the firm." So the act two, what I'm describing is acquiring distribution, and I imagine that's the rub that a lot of the audience, that's where it feels disruptive and that's where it feels threatening, is that
Yeah.
that acquisition of distribution is now competing with them, and they have this new entrant of competitors that they didn't actually know about before your talk.
Yeah, I think so. By the way, there's this rumor going around, and I'll perpetuate the rumor just because it's an interesting rumor that says, what if in our space, two of the big software players, Autodesk and Bentley, there's a rumor going around that says, what if Autodesk and Bentley decide to compete with their customers, i.e., they already have all the design data. They have all the design data. Advent of cloud, they have all the design data. Their customers have already trained, call it the AI model. So why can't Autodesk just go directly to the end customer and be in the architecture and engineering business? Same thing with Bentley, right? And I always say, well, if Bentley was still private, then I would be worried. But for both of those companies, as a public entity, like, I don't see how they could do it, right? I just don't see how they could do it. It'd be too much turmoil. They'd have to go private first, is what I would say. Now, if they went private and did it, then I would be worried. But as a public company, I don't. I mean, a lot of these firms couldn't even move from on-prem to cloud as public companies, just because revenue recognition would just trash their earnings for like a couple of years before they saw, before they could gain the value of SaaS revenue versus license revenue. So they already went through that and struggled. And that was an obvious one, right? So I don't see it, but it's an interesting concept, right? It's an interesting thought experiment than more than anything else. And so I think the this idea that um, we can use like AI and build the next generation firm. I think what these folks really struggled with was that we went out and talked to their customers. And so I think in the process of talking to owners and developers and asking, how do you feel like your AE firm is serving you? Are they serving you well? Are you happy? And the resounding response was, they're a necessary evil of what we do. They're not happy. And the firms that we saw, the attribution of firms that actually had high customer satisfaction, were smaller firms that were spending the time and understood the customer's needs. So now if you say, well, in a world of leveraging AI for high personalization or a different type of customer experience, can a 25 or 50 person firm that has kind of that their customers actually do like them, can they now scale those businesses using AI and drive a higher level of customer satisfaction? I think the thing that really bothered people is when typically when they say like, well, I mean, our customers won't go for it, is their response, right? Like we are the way we are, we do business the way we've always done it because that's how our customers dictate it to us. When I show up and say, no, we talked to 200 of your customers, and that is not true. They are not happy with things, how things are going. They would like to see change. I think that probably freaked them out more than
Mhm,
anything.
mhm. Yeah, so the constraint previously on high customization was you can't scale it, right?
Mhm.
Like you can be super localized and have a good lifestyle business, but you're not going to scale to compete with the players that you're
Yeah,
referring to. But it's
right,
it's feasible to do
right.
that today. Yeah, and
Yeah,
that's
because
and that's threatening. Yeah.
yeah, because mostly, you can make a great living as a 50-person owner, a firm owner of 50 people. I think this
Mhm.
applies to most professional services, lawyers, accountants, right? At 50 people, you're probably have enough infrastructure. You're not like in that seller doer death loop where like sell the work, do the work, sell the work, do the work, and it's feast or famine. You're probably out of that because you have enough scaling in the system. You have other people doing some stuff. But the next real scale point to where as a owner you can make good money is at about 250. So from 50 people to 250 people is this weird valley of death that you actually become as an owner, as a principal, you probably make less
Mhm. Mhm.
during that till you scale to about 250. And of course, at 250, keeping up customer satisfaction and that client intimacy the services requires is very, very difficult.
Yeah. So some more details on this strategy. So let's get into the mechanics. So essentially, what VCs are doing right now, and we'll call these the kind of the large generalist VCs, all the big names that most people are familiar with. They're going to target sectors where 30% of task hours are automatable. Essentially today with the foundation models that we see. So that is a prerequisite. 30% of task hours are automatable. Another Another part of the playbook mechanic is there's no to low leverage used early, which is really different. So this is not like a debt heavy strategy. They're taking VC equity and they're using it to buy the company and then build the technology stack. Um, During my research, I found something that was really interesting that I didn't know before. Is the idea is actually the idea is not to reduce the costs out of the gate.
Right.
So when a big VC invests in this concept, it's very different than a PE firm where they're not taking on debt, but the intent is like not to reduce costs by 15 to 20%. They're not firing people.
Mm,
Instead, what they're doing is they're keeping the exact same cost structure and then embedding the software, and that software alone should allow them to take on 2 to 3 times the
yep.
customers in revenue than that previous, headcount that they were able to scale with that previous headcount. So,
Mhm.
um, I thought that was really interesting because that playbook is fundamentally different than a PE playbook, which is like, hey, we're going to come in, we're going to cut costs, we're going to trim the fat, we're going to,
Yeah.
we will purchase things that have high ROI, and we'll take on debt to do that. But that mechanic, I think, was worth calling out. So essentially, yeah, they're spending equity to add software engineers, data infrastructure, AI subscriptions, and again, the goal is to take on 2 to 3 times the
Mhm.
customer count, which directly translates to 2 to 3 times the revenue.
Yeah, I think what happens, I mean, I think that's fair. One, it's like, "Hey, we have more work than we can handle," is usually the narrative, right? That's what you're looking for, I think. The second thing is, as these firms have grown, they might have exited businesses or service lines that maybe they were lower margin because their cost to serve, if I have a $250,000 a year electrical engineer I have plenty of work at $250 an hour. Why would I have them go do work that's $150 an hour, right? So you kind of optimize to drive your service lines around the most profitable. We've seen it in even through some of our portcos, right? Like bridge inspection is hired by DOTs. They'll only pay like $75 an hour. So why am I going to take an engineer making 100 that I can bill at 150 an hour to go do bridge inspections? Let's just get out of that business, right?
Mhm.
So what you can do is you can retrench into businesses like service lines with your clients that maybe you opted out of before because the margins weren't there, but because of technology, you can still keep your cost to serve in a place that makes margin sense because you're leveraging technology. And so I think you're seeing this kind of, call it like vertical integration of services where people have opted out. I mean, you've seen this in every industry. It's also been that way in services. If you're an architecture firm, maybe you exited your structural engineering business and decided to subcontract it out to structural engineers because you couldn't keep them busy enough. Like when you were busy, they couldn't handle the capacity. When you were slow, you had nothing. You couldn't have structural engineers do architecture, right? So instead, maybe I re-enter structural engineering, stop subcontracting it out because I can hire a couple structural engineers and leverage AI. And instead of having a team of 50 sitting around, I have a team of 2 sitting around, but I have the power of 50 to execute the work. So I think that's where there's like this weird kind of, I think we talk about vertical integration mostly around product businesses and supply chain. In some weird way, if we want to talk about people as supply chain, I think you now have the option to vertically integrate service lines as well that maybe you exited before, but it in many ways just makes sense for you to be in.
Mhm. Yeah. Yeah. Let's talk about the VC advantage versus PE in this world. So for any of our PE listeners, here's why we believe VCs are better suited to execute the strategy. I think it's like fair. It's fair to, um, it's a fair argument that PE firms could, in theory, go try this themselves. But the reason VCs have an advantage is obviously it's technology first. You're actually building software. You're
Mhm.
incubating it from scratch, and that's essentially building a startup, fundamentally different than any PE playbook, right? You're dealing with the people you're dealing with are CTOs and engineers,
Mhm.
not your standards corporate C-suite management team. So you have to know how to speak their language and relate to them. And
Mhm.
then the value creation is via software and data compounding, not cost reduction. We covered that one. Where so the old world, the PE structure, it's going to be a capital structure, debt structure, and then it's about operations discipline. And the value creation was via process, purchasing, SG&A reduction, and sometimes tech enablement. Tech enablement was always a factor, I think, for forward-thinking firms, but was never the core driver of how they increase the value of that company. So, when you have these different core attributes, underlying attributes at play, you have questions about change management, you have questions about data rights, you have questions about model brittleness, um, you have regulatory and antitrust questions, talent scarcity questions. I'm curious to hear your take on this. I don't think a PE firm wants anything to do with those things, nor do I think they understand exactly how to execute that strategy.
Let's simplify it even more. What percentage of PE people have MBAs?
90%.
Probably more. Oh, but if they don't have an MBA, they have a law degree. What percentage of VCs, I mean, the good ones have MBAs?
10%.
There you go. That's
Maybe,
your
maybe
answer.
less.
The industrialized complex of MBAs does not leave much room for creativity and like thinking, like even first principle thinking, right? Um, I mean, I know that's I'm sure there's a couple MBAs listening to this. By the
Cheap shot.
way,
It's a cheap shot.
little cheap shot. Also, like on your LinkedIn profile, do not put MBA as credentialing in your title, please. Generally, when I see that, I look down and it's like, oh, like, okay, you attended something. But anyway, um, it's not a cheap shot. I think it's a pattern of thinking, right? I think some people, right, are going to go down the MBA path and get trained in a method and system that is highly scalable, right? That's why we say PE scales really well, right? PE scales really well. VC kind of doesn't scale really well. There's too much of that 90% artisan experiential thing. So it's not, I don't think it's a cheap shot. I think it's a different sport, right? We're both skiing. They're just doing cross country skiing and we're doing downhill skiing, right? It's a different skill set. So, maybe it's a cheap shot because I have not earned an MBA for the record. But I think it's a pattern of thinking that you build in your career. If you went from, you get your MBA, you go to McKinsey, you go work at a PE shop, you have, your standard formulas and metrics and ratios that you live with. I mean, what comparative ratios are we running when we invest as VCs? It's fairly limited. We operate with such limited information. So that's our comfort zone, right? Our comfort zone.
I'll be honest, the first time I mean, not the first time, but the amount of times I've uttered the words EBITDA really has only happened in the last, I mean, it's very, very small scale. Only happens when I'm talking to LPs who are selling their companies. Or two, we're looking at this strategy in the market, like from the VC perspective. So like this is a new concept where we're actually looking at the underlying financials when we're investing. I mean, usually when we're investing, just to give people a really clear picture, we have zero revenue or very minuscule amounts of revenue, and a couple customers that maybe they got through friends and family, and maybe one or two investor introductions. Usually nothing repeatable at that point. So the amount of data and the financial metrics is completely non-existent. And so any analysis that we're doing is like very future looking, and we're anticipating and making a lot of assumptions. And so while I do think it's healthy to like know the capacity of, I have seen VCs talk about projecting out the TAM. Like obviously TAM's a big component to underwriting, but running the real math on that from a bottoms up standpoint, and like having a certain degree of conviction that's not cherry picked about how big that business can get at the concept phase is a real thing. But beyond that, like you got to make sure the margins check out. You got to make sure that their go to market sound. But there's really not much analysis to do.
So what do you think? I mean, so here's another thing that I think people. So I think that, to answer the question, I think it's a pattern of thought, right? It's over time we learn how to do certain things, and we stick to them. Like I'm trying to learn pickleball, right? And I'm a career tennis player and ping pong player. And this pickleball thing, I can't decide when to use my ping pong skills or my tennis skills. I'm pretty good at tennis and ping pong, but for some reason pickleball, I just can't figure out, that the pattern of motion and all feels familiar, but is very different.
You need a new paddle. I think you need a new paddle.
Maybe.
If you've got the natural tennis swing, I think you can figure it out.
Yeah, possibly. But you know what I mean? It's just like it's a re-engineering of thinking, right? So I don't think it doesn't mean that MBAs can't do VC and non-MBAs can't do PE. I just think you train a certain way and have a certain swing, and maybe you adapt. I think one of the things that that I've found interesting, right? I think we have an idea about what we live and breathe every day as VCs, that I think sometimes we forget what the outside view of VC is, especially people that are not as in it. They read from the sidelines what VC is. And someone said something to me that I thought was very interesting. They said, it's really interesting that VC-backed companies seem to have a lot more run-ins with the Department of Justice and antitrust than traditional companies do. And they said And I was like, really? They're like, yeah, it's because you guys have a winner takes all mentality. There's Google, and then there's Bing, right? And there's Apple, and then there's so I think there's something that maybe we don't realize, right? That when we talk about these venture pathways into these industries, maybe some of the fear comes from a bit of a winner takes all mindset that I think we do have, right? We do have that mindset when we talk about when we think about a TAM, total addressable market, and we're trying to figure out how much of that TAM we can take, right? I don't know that PE thinks that way, right? So I kind of asked the question to you, like, is that part of like something, a blind spot that we don't see culturally, that we're viewed as kind of people that have a winner takes all mindset versus a play well with others mindset, which is the antithesis of this industry.
Yeah, I mean, I think let's talk about why there is a winners take all mentality in the technology space. It's because there's no like the game of VC and the game of technology is a game of scale. You deliver quality, a high quality product to someone at scale. You can't win in VC, you can't win in technology if that scale quotient isn't met. And when you reach a certain scale, there's all these compounding advantages that start to, that start to matriculate back to the core business. And so, that's why Google wins. That's why OpenAI is in a massive lead, right? There's so much compounding benefit that comes back. With Google, for instance, like once it becomes the dominant search engine, all the views, all the like, all search queries, because it's a better product, the data is getting more refined, the feedback loops are tighter. It's a better search experience every single second. So then you just
Right.
you accrue more and more customers. And so like the question is, will that happen in this dynamic with with AI rollups, and in particular to A&E? Can it happen where scale can occur? PE firms, they scale through capital, but there's always a constraint. There's still a bottleneck on that capital unless you have, hundreds of billions and, potentially trillions of dollars. And no one's really owned, the A&E space and taken real market share because like those compounding advantages are really constrained.
Yeah.
Unless you're using technology to improve and compound the product over time. And it was a people scale, it's people scale, it's capital scale, it's different. So the product experience wasn't occurring for someone like, so let's call out some people like AECom, Jacobs, WSP. These are massive firms that, as they scaled through capital and through acquisition, did their platforms get better?
No, they got worse.
Did they accumulate an advantage over time on cost?
Actually, in many ways, a disadvantage. In many ways, a disadvantage.
Yeah.
Because they acquired so many companies in such concentrated sectors. They were almost like they reduced the odds. So if they reduced the odds of winning because they already owned, if a client says, hey, I need bids from 3 firms, if you own the firms, how do you get a competitive? Like they had to make room for competition, right? They had to like divvy out the work to other people. But so my friend runs this company called Udia. They're an AI legal firm, and they've acquired a bunch of law firms. And he sent me a note inviting me to his annual summit. And it was mostly like his customers were speaking. And it was probably like 50 of the top Fortune 500 general counsels were there. I was like, the firm is 2 years old. The company is 2 years old.
Yeah.
So it feels like he's on a path to like winner takes all the Fortune 500. And then it's just a matter of choice to go from there. Right. So how much of it's market dynamics? And it's more of a question back to you. How much of it's just like how we're wired versus the market and how we like strategically. I mean, we kind of don't like losing, and our idea of winning is that there's only one winner, right?
Yeah, I mean, I think the mentality is if you create the best product experience, which that's the goal
Mhm.
of these VC roll-ups, is to create the best A&E product experience on the market,
Mhm.
a service experience that's tech-enabled, right? If you can create that and you feel very confident that, that customers agree with that assessment, why not capture the whole market? Like, what's the constraint? Well, why don't we throw more capital at it? Like, that is the VC mentality for sure. And I do think that is different than PE because they haven't participated in that game before.
Yeah. I think there's also the time horizon, right? If a PE is doing their 5-year flip,
Yeah, totally.
right? And
That's
I'm
a
not
good point.
there's no it's you don't care, right? You're not trying
Yeah.
to dominate anything. You're just trying to flip an asset, right?
Mhm.
Not that I'm generalizing, not all PEs are wired that way, right? But and I think that's the difference. When you look at the pools of capital that VC is forming, the capital formation around these ideas, they're not even doing the 10-year
Mhm.
typical fund typical fund. They're doing evergreen,
Yeah.
which kind of implies like, oh, they want to hold these things forever.
I think that's a great point. I think the mindset is entirely different around liquidity,
Hmm.
which drives a totally different behavior of incentives for sure. I think
Right.
that's a really good point.
And I mean, and it's interesting not to go down this rabbit hole too much, but it seems like VC, maybe it's because of secondary markets and like this way staying private longer mentality. I think was maybe by accident in previous fund vintages, like previous years. I don't think that was a strategy, but it does feel like with some of the new capital formation that there isn't a push to a 10-year liquidity event and that the startups are even staying private longer. And as you see the formation of secondary capital pools, when you need liquidity, either for employees or, I mean, who was it just did a tender offering? I forgot who it was. Someone had just done a tender offering just for their employees, right? So their employees could get some liquidity. So you're not even selling this strategy that says, hey, your stock options or your restricted stock units are going to be worth so much over this 4-year vesting period when we go public. It's literally saying, like, no, I mean, you can secondary market it, whether it's SpaceX or and our friends at Anduril, right? There's some theories that say they could, but I get hit up with brokers all the time trying to sell me secondary shares in Anduril and stuff, right? Um, so I mean, I think if you take that along with some of these longer term strategies of going and dominating a market, look, I don't think anyone that's venture backed is trying to have a share of the market. I think we're all wired way too differently to change that. I
Mhm.
don't think we're satisfied that way.
Yeah, I also think as you look at, each tranche of financing in VC, this is, the tranching between the two different asset classes, PE and VC, it's also quite different in terms of the time horizons and the expectation on return, right? So if you're a, if you're a VC and you're investing at Series A or Series B in one of these concepts, you still have like, 5, 7, 10-year time frame. Like you're not like, and it's fully liquid. You're not expecting a quick flip. I think if you're investing in a really late stage PE concept, like you're not waiting for 10 years. Like that's the expectation of the LPs and why they're investing. It doesn't have that liquidity profile, and it doesn't
Yeah.
have like the risk reward is entirely different. So yeah, I think the mentality and the incentive structures. I hadn't really
Yeah.
thought about that as much, but I think you're exactly right about it.
Yeah, and I think also, like, if you're a long-term shareholder, like, do venture firms, do venture funds start issuing dividends? Because these businesses are going to be profitable. They're not, right? Do you start issuing dividends back to your LPs? I mean, it's a very interesting
Yeah.
world. I mean, I was talking to one group that's doing this, and they set up it's an evergreen fund, and your money's tied up for the first 3 years. But then after 3 years, every 6 months, there's sale windows where you can sell your liquidity, sell your share,
Mhm.
your equity back to the firm.
Mhm.
And so there's these sell windows. And so I think giving people this optionality, investors, right? And I know we're digressing a little bit from the first conversation, but I feel like where venture capital is doing a better job than private equity is actually listening to LPs and adapting to their needs.
Mhm.
Right? We're not stuck on, oh, well, it's a 10-year and you're locked up and there's no liquidity, and the only way to get liquidity is an IPO or a sale of the business. Now we're saying like, no, we're going to invest in long term. Um, we'll pay you out in crypto, whatever it is. I think that's where VC does do better. I think PE is like, well, no, this is how it works. This is
Mhm.
how we underwrite things, and
Way more rigid, yeah, in the whole
yeah.
structure. Yeah, agreed. Okay, so let's get back to the ending of the presentation and the talk. Everyone's feeling threatened. You have zero awareness about this, but you're you're going through your slides and you're getting to the end. You're pointing out all these fundamental differences that the floor underneath everyone is quickly evaporating. What like what was the instruction on what they should do with all of this happening in the background? Like, how did you like what direction did you point them in terms of taking action steps?
I mean, honestly, I just said like, "Hey, come talk, come grab me, come talk to me." I think if you're looking at trying to do something with your firm and you thought only PE or a PE sale or sell to your employees, because there were some ESOP people in the room as well that want to help you start an ESOP. I think, hey, here's a new option. Come talk to me. And I mean, it was a room of about 300-400 people, I think, something on that order. I probably had 20 to 50 people reach out to me. Because I think some of them, I mean, I think after the initial shock, and of course, there was a lot of grabbing me at, dinner and happy hour and having a conversation. What I found interesting is, so a lot of companies that were already private equity backed that are getting ready to go through some, what they call a recap, i.e., it's been 5 years, the private equity firm wants out, and they're going to flip it to a new private equity firm. Those people seem much more biased to having a conversation with me. In other words, they had already experienced what private equity felt like, and they weren't sure if they wanted to go through another 5 years of that. Right? I mean, none of them could say anything negative about private equity, but you sell, you go through 5 years, they're getting ready to recap you, and you're like, do I want another 5 years of this? Like, now I know what it feels like. Is this really what I want to do for the next 5 years with another private equity group that's probably larger and now has, bigger expectations? Is this really what I want to do?
Mhm.
Right.
I think that, just one call out on that. I think the cycle of, hey, I need to sprint to these exits with PE firms, it's really unattractive,
Mhm.
if you're in the ownership seat because man, it's hard. Like it's hard to it's hard to shift the boat so many different times and change the cost structure and just keeping expectations high for for these different short sprints is like the idea of a sprint is you sprint towards something and then you take a significant break, right?
Mhm.
Like you got to let the machine, you got to let the body
Yeah.
recover. But we've been programmed if you're on that cycle to, kind of keep sprinting.
Yeah, it's funny. It's really funny too. Like of course, they had a bunch of PE back. I wasn't the only speaker there. I got to hear from other people, which is fun. And one of the big metrics around this M&A stuff has been employee retention, and it's not great. It's not great. I mean, hey, yeah, we're selling to so and so. You're going to get some liquidity in your employee stock ownership. But nothing's going to change. Like they bought us because we built a great firm, which is the biggest lie ever, right? everything changes. In fact, one of my friends is the CEO of an engineering firm, told me that he basically tracks these PE sales, and he'll like have his assistant go on LinkedIn and find all the people on LinkedIn that are in revenue driven positions at these firms. And then he just makes a list and he contacts them about 6 months in to say, hey, how's it going?
Mhm.
And they're like, well, not that great. I got 6 more months to get the rest of my money.
Yeah.
And then I'm going to be looking at options. And he's like, then I hire them.
Yeah.
Right. In fact, I had one PE group telling me like, hey, there's a whole group of people that build companies, get them to 50 or 100 people and sell them to us. And a year later, they go back and do it again.
Mhm.
It's just a machine. So I don't know. I think, I look, it's the most interesting of times, right? You take AI and you take these new capitalization models, you take VC, you take all these things, and you throw it all in a blender. It's probably the most interesting time in this industry.
It's a good way to end it.
Yep.
Part 2 in the books. Look out for parts 3 through 10 coming over the next couple of years.
I think we need to have a guest on.
Yeah, we should totally do that.
I think we should either have a PE person. I feel like we agree too much.
Mhm.
We are like we're just the problem is we spend so much time together, right? So whatever we have, we don't leave much to argue about on the podcast. But I feel like if we found some folks that just do not believe there's no way VC can do this or whatever.
Yeah. No, for sure. I mean, let's get the counter perspective on it.
Yeah. That's more entertaining.
Mhm.
I mean, us just being right all the time gets boring.
Yeah, I mean, even if it's true, it's still boring. Sounds good. Let's do that.
All right, man.
TBD for the next one. All right.
All right. Talk to you later. See you.